Good morning, everybody. It is Monday, January 10th. We have a lot to talk about. Again, I'm a little bit behind because I had a tragedy this weekend. My dog, 13, who we knew was having episodes since summer, finally had the big one, and had to let her go. So goodbye to Belle, and yeah, to anybody who's lost a pet, I tell you, it's tough. It feels like your internal electrical system was all screwed up for a while. And I'm still in that screwed up phase, but got a lot of work to throw myself into. So let's do that. All right. On Saturday, I was uploading the Friday video. I wasn't aware that it didn't finish loading, so it's now loaded and it will work for you. So go ahead and watch the Friday ETF video. And I'm going to start with YOLO here, the marijuana ETF, and then we'll probably full circle back to it. But when it was way up here, I told people, no, don't buy it. And it came down and came down and came down. I said, no, don't buy it. Well, now I'm telling you, we're pretty much there. Shooters, Elliott wave number is just right around 10, just a shade under 10. I think it was 987. So I think that given how well it's holding up, probably if you don't have a position yet, get your starter, just a tiny itty bitty piece, just a holder position at least, because with as bad as the market is doing, this one is just not getting beat up. If there's margin calls in the next few weeks, it'll go down maybe a little bit more, but man, this is really behaving well. But I do plan to back up the truck at 10, so maybe even 10.50, but we'll see. But this area in here, right here, that's what it's going to test, and I think it's almost impossible that it breaks below, just based on the top 10 holdings where they're already trading. So I'm going to do an article on this. I don't know if I'll get everything done tonight. I have a couple other things going on. That buddy Al that I've been telling you about, who's having the hard times with his cognitive issues after getting over cancer, he needs a little help tonight. So a lot of running around, probably be up till 4 a.m, take a nap, and then be back with you tomorrow. But YOLO here, man, is it holding up well? And this is the first test right here. Does it break under 12? It's holding on. The reason why I tell you to get that starter is because it might hold on, but it looks like 10-ish is the bottom here. So this will be probably the first one you get into. The plug and play ETF is one thing that I will get done this afternoon. It's already mostly done. And YOLO is going to be a holding for all the growth investors. And honestly, even if you're retired, if you just look at it from the standpoint of it's a good investment based on, what's really going on in the world with the shift from smoking and alcohol to marijuana, particularly edibles, it's a heck of a market. It's just a heck of a market, and it's growing all over the planet. So having this basket, I think, could be one of your best growth baskets, and the millennials love this. And I will tell you, I've been reading on Reddit. They're already starting to ramp up plans to pile into this. It's starting to get talked about again by the millennial crowd. So somewhere in here, you really want to own this, because the next wave, I believe, sets new highs. I mean, the stocks are just going to be monumentally profitable. So you'll want to get in there. And remember, the one thing that held marijuana stocks back was they didn't have full integration into the financial system, and that's changing. So this area here, right, that was just the COVID crash. This area here and here, we're getting a triple chance here. All right, so let's go back to the beginning. This is the put to call ratio. A little over a year ago, actually about 16 months ago, I talked about how the millennials who were loading up on leverage and calls might flip the switch and start buying a ton of puts. And for a hot minute, a month or two maybe, that would just crush the market. We might be seeing that. The put to call ratio has been rising for about 2 weeks, 3 weeks. And if it jumps all the way up here, that would probably mark a bottom in the market, because as the put ratio goes up, market probably comes down. How do we know that? Well, take a look at when the put to call ratio bottoms, the market starts to drop. And then when everybody piles in, market starts to go back up. So what you want is a very contrarian view here. So when nobody's buying puts, better watch out. When everybody's buying puts, hey, look, it starts to go back up. And then they stop selling the puts. They stop buying the puts, market falls. And the correlation is pretty direct. So right here, everybody was starting to buy puts because they said, oh, here comes a correction because of the Fed. And everybody bought these puts, and look, market went up. So everybody hated puts. Again, market started to come down. So as people love puts again, at some point, and I believe it'll spike up at least this high. I think that we're going to see a huge influx of puts. The millennials, the Reddit crowd, the Reddit army, whatever you want to call them, the Robin Hooders who get prodded into doing things by the little emails they get from Robin Hood. And really, if you go to all these trading rooms online now, it's really just, it is total herd mentality. And it starts out with a whisper, and then they call it a deep dive research. It's really secretive. It's really like, this is exclusive. It's not. It's bullshit. It's just, look, this chart is all you need. And as this shoots up, we'll probably get a wipeout in the market. I'd say this is one spot to look at. This is another spot to look at. But we could, see a cap right about there and do it 3 times. So up and then down and then back up. So we have to keep an eye on that. What does that all mean? Well, it means that QQQ is probably going to get into our buy zone. Now, I don't know exactly where. Shooter so far is saying right in here, and I'll show you his charts in a minute. But I think that probably we see the zigzag here. So A, B, C, and maybe it turns into 5 waves down. We'll see. The chatter on Bloomberg today, the narrative of the day was, hey, we're going to get 4 rate hikes this year. I tell you what, if we get 4 rate hikes this year, 4 rate hikes this year, it either means that the world is the best that it's been in a very long time, or the Fed is stupid. I don't think the Fed's stupid, so maybe things are really starting to look up. I talked about that the other day. I said, look, if inflation dissipates, which it will, but wages are sticky and higher, that means cost of living will be level while people's wages are higher. And that's really good for economic development. And we have all this capital out there running around in different directions. Remember, there's always a winner in every trade. So the money doesn't disappear, it just goes into different hands. And as I've told you, I think the millennials are really good traders. So we have to take our cues from them because they're the marginal money in the market. And you're probably not going to see a knee-jerk reaction from the pensions or the other institutions. Now, your mutual funds, but they're less important nowadays because everybody's in ETFs. 2 things we have to watch out for is the flush occurs when the old men sell, because that's what old men do, is they panic. Every study shows that it's the old men that panic, so don't be an old man. And remember, if you're going to sell early and sell big. That's a lesson you should completely have in your head. Right now is the time, hey, if I think that I'm at risk, and actually I've been telling you this for months, you should have been scaling out for a long time. And at this point, if you're not at the cash allocation that you want to get there today or tomorrow. I don't know if we'll have a pop tomorrow or a continuation down. Hard to know. But given that we're probably getting in here, the S&P 500 is doing something similar, sell early, sell hard, sell big. That is one of the biggest lessons I've learned. And if you talk to some of the biggest investors out there, they say, look, sell big and sell fast. Buffett has been scaling out of the market for well over a year now, since about when I started. And because our trades are little and gradual, it works out. You have that 1 year maybe where you're behind, but then, well, holy cow, I got all this cash to invest at the bottom. This time we'll catch it. All right, so compare QQQ to IWM and SPY. This blue line on top are the small caps. Look at that. The small caps have actually outperformed since the dot-com crisis. Let's look at some other dates. Here we go. The bottom of the Great Recession, QQQ goes nuts relative to the S&P 500 and small caps. So for the last 13 years, small caps have underperformed after outperforming for 100 years. So is the long term going to be different, or was it just the intermediate term that was different? I don't know. Let's go to that flat period, 2016, where I told you, look, that 2016 flat period was pretty important. Might be setting the baseline for this market if we get the Armageddon scenario. QQQ still outperformed, IWM way below. Now let's take a look at the last year. Holy cow. But look at that. The S&P 500 kept up with QQQ. Let's take a look at the last 6 months. Still underperforming. And now let's look at the last month. Just recently, small caps starting to perform pretty well. And that's why I told you there was blood in the street on small caps. Look how the line is moving up, just starting to. At the start of new bull markets, a lot of times you get rallies across the board. And people say, oh, look, my QQQ is going up. But the reality is that usually, historically, going back a lot, decades and decades and decades, the small caps would just crush it at 2 spots in the cycle. And early on here, and then moving in later, these small caps, I think, could beat the entire cycle maybe this next time. Why? Again, not a lot of people are saying this, so it's not the popular narrative. But the great divergence, which is what I'm calling the separation between the quality companies and the not quality companies on the S&P 500, is basically here. It's already started. You can see it happening in the market. Your lower quality companies, your companies without growth, your companies without some sort of special asset that's going to keep them with a moat on their business, are all starting to lose investors. And not just the millennials who never were in the first place, but the institutions are selling down the lower quality. And you can see the market caps on about 200 stocks in the S&P 500 just not going up and starting to turn over and fall down. Chart after chart after chart after chart. So when I screen for the S&P 500, where's my S&P 500 screen? Take a look at the price ranges. This is the price of the stocks against their free cash flow, 5-year range. Look at how expensive a lot of this market is. Just starting to come down. You know, that was 250 stocks. Not a single one even in the middle of its range yet. They get all the way to around the 300 stock, the S&P 500, before you see something even in the middle of its price range. You're getting almost to the bottom. AT&T, William Brothers, Level 3. Now, against their 5-year average free cash flow, or their 5-year price against their free cash flow, starting to see some value. Kinder Morgan, cheap. Energy, cheap, right? Now, some of the other pipeline and oil companies are cheap, but there's a reason for that. It's because people know that their businesses are in trouble. So a lot of these businesses aren't actually in trouble. Get your last couple in here. Enphase, which is on our list. Look how cheap that one is against its cash flow. We're about to get an opportunity to buy Enphase and a lot of the clean energy companies. Because when people chant, oh, they're not profitable, well, that's kind of bullshit. The company's pretty cheap against its range. The forward peg, price to earnings of growth, which you want a number under 2, closer to 1 is best, is already down 2.1. And these stocks usually run hot between 2 and 3. So when you can get them with a 1 handle, pretty good idea to do it. So if we rank this by price to earnings to growth, we start to see just a handful of companies with some emerging value. Cummins, they're on the list now, pretty cheap. Not as cheap as we want, though. Let's keep an eye on that free cash flow and see where they end up. Keep on coming down here. These are companies that are borderline. They're in the 1s. Then we see all these companies overvalued again. So Shooter pointed out that American Tower has got a down leg coming. So if American Tower gets down into the 1s and this free cash flow price gets down here, then holy cow, we can get American Tower on the cheap. Same thing on a lot of these. Crown Castle, not cheap, but starting to get there. What do those flushes look like? Well, let's just take a look at Crown Castle here. It's in the middle. The range has been from 30 to 100. Get down to the 30s, right? And right now it's about 50. You're still looking at a 30-ish% drop. A lot of things can happen between now and then, but you really want to see cheap. If you want cheap, there you go. Otherwise, you have to be a momentum investor. Right now, the momentum is down. Here's Shooter on the small caps again. He's actually showing, some opportunity here soon. I would anticipate the alternative counts come into play. So I don't think we're at a jumping point yet. If you're a trader, you might have a little move to make, but you're probably looking at a price in here if you're going to buy the index. The thing is, a whole bunch of the stocks that aren't even in the index yet, like the SPACs, are trading at almost, prices where you would just assume they're going out of business. But if I told you, when a stock trades like it's going out of business, there's only one question you have to answer. Will it? And if it won't, if it's still going to be in business, you can go ahead and buy it. But mind the momentum. Come back to YOLO. Don't forget about that one. A new one on the list is the VanEck Gaming ETF. For those of you who only buy stocks or mostly buy stocks, we'll be looking at MGM and Caesars. And I was really gung-ho on the Golden Nugget thing, but we're not going to get a chance at that. So Caesars and MGM are going to be two of the stocks that we look at. And, we'll see. Otherwise, you can pretty much buy the whole complex for your asset allocation if you don't want to deal with single stock risk. I'm probably buying the ETF unless there's really good trading available in the stocks. And I will tell you that Caesars in particular is loved by Wall Street. And I think the millennials probably jump on it too. So if we get a chance to buy Caesars, that might be one that, you buy an asset allocation with this fund, and then you put a little bit of money into Caesars and or MGM as well to build your basket. So I will write a little piece on how to build your gambling basket too, with a couple different options, depending on who you are and what kind of investor you are. All right. We're just not going to cover a lot of stocks today because they're not ready. They're just not ready. So let's take a look at Invesco QQQ. This market could end up going pretty low. I don't think we're going to get down here, but this is the bottom of the buy zone that I showed you, right? I'm saying 270s, shooter right here, 272. One of the things that I mentioned in the chat over on Rare over at Fundamental Trends just a minute ago is I said, look, it's pretty amazing that Shooter and I end up near the same type of price ranges pretty often. Why does that happen? Well, he's using Elliott Wave and Fibonacci ratios, and he is adding harmonics, which is pretty complex, but he uses those technical items, and it narrows down the range pretty well. Anytime that you get over half of your trades right, you're doing great, because all you have to do is ride your winners and sell your losers. And I think we're probably both at 2/3 right over our careers. I've been a little cold lately because I just been afraid of this whole QE thing unwinding. And Shooter's been, taking part in the FOMO. I think he famously said last week at heart, he's a chaser. So, if you want to FOMO it and you want to chase, you need to be over at Fundamental Trends with Shooter, because he'll get you a few trades every week. But here we see what a breakdown could look like. And here's your Armageddon scenario. Can it get here? I'm not going to say no, but yeah, this first one, if you're a trader, you can, buy in here and try to get a bounce, then sell, and then buy again back down here. I really think that if the momentum keeps coming and the Fed does keep appearing to be hawkish, you're going to see this drop down here. We've talked about the dollar a whole bunch of times, and this dollar chart, it's pretty strong. So if it gets all the way up here, it's not that big of a deal for it to get way up here. And that means that asset prices stay under pressure and international investors keep pouring into the dollar. If you go back to February and March of 2020, what did we see? Dollar jumps up, right? And then it starts to march down. But what happens as the dollar gets weaker? Stock prices go up. So as this dollar spikes, that'll be our signal, probably around here, that stocks are about as cheap as they're going to get. So we just need to keep watching this and understand that we're pretty close. This is maybe only a month or two away, 3 maybe. And then once all that foreign money that was in money markets is no longer benefiting from a rising dollar, what are they going to do? They're mainly going to just go out and buy QQQ. That's what they did last time. It's fairly sophisticated money, but they don't trade a lot of individual stocks. They buy the QQQ for the most part, or Apple or Microsoft. I mean, they might buy a small basket, but it's basically QQQ stocks with a couple others. So right now, foreign capital is not entering U.S. stocks and real estate. China has a role on that in particular. But money is flowing into the bank accounts, into the money markets. I can find that chart again. I just looked at it. And that money flowing into U.S. money markets at some point will flow into U.S. assets. Prices have to come back though, so it's coming. It'll happen, right? I've talked about this a lot. Way back here, I told you, dollar will rise under Biden, then which is happening. Then the next question is, does the dollar stay sustainably higher? It might, because the advantages of the U.S. economy are, and Buffett talks about this all the time, right? The benefits of the U.S. economy, the advantages of the U.S. economy are so huge that the dollar really should be strong. And this uptrend that I identified on Market Watch way back here, look, whole new channel we're in. And what if we get into a new channel down the road? I think we will. I think we'll test this. I think we'll come off. Then I think we'll break through. And for you as an American, having strong dollars will make your life easier to live because cost of goods and services will go down, especially anything that we import. The prices of what we sell overseas, because we're not commodity driven, we're quality driven. Cost of what we sell overseas will go up. Consulting prices will go up. I'll just tell you, America is sitting in a really good spot. And the only hurdle we have left to get over is what to do about the boomers retiring. I would tell every boomer out there that has a job that they like, work until you're 70, or at least part-time. I plan to work till I'm 70, full-time. We'll see what I do after that. That would be good for the economy. And if we are smart about how we fix healthcare, and I think we've been moving in that direction, then the boomer bust won't be so bad, and we might not even have to print that much money. One of the things that did come up on Bloomberg today is a couple of knuckleheads talking about how the Fed could shrink their balance sheet. We get 2 years of moving sideways. Maybe. They were chest thumpers, so I didn't put a whole lot into that. If the Fed does shrink the balance sheet towards the end of the year, then maybe this is not just one bad year, and maybe we get a 2015, 14, 15, 16. Maybe we get a little over 2 years of choppiness. I don't know. I'm still going to buy the S&P 500s, winners, and the QQQ when we get to low enough prices. So between now and then, if you haven't been reading Shooter stuff, if you're on margin of safety investing, we're already conspiring to kind of take the highlights over, but none of the short-term charts, none of the trading stuff. Trading stuff, you got to go into his chat room over at Rare over here. But if you're just looking for the signals for long-term buys, those will migrate. Basically because when his charts and my charts agree, that's pretty strong. So you want to keep an eye on that. One thing that you can read for free for now is you can read about his crypto report, which he must be drinking a lot of coffee because he's been getting a lot of work done. So I have to catch up. But his crypto report's really good this week, Shooter. This is just, if you're not reading this, you just gotta read this about how he's thinking about it. And he's trading it, right? I'm not. I'm just accumulating Ethereum. And if I get a bargain price on Bitcoin, he's saying maybe down to 30,000, which is what I said a long time ago. I have to start thinking about it. Do I want to buy Bitcoin around 30,000? Or in the monthly chart, could we break this line, get into the 20s again? I don't know. I just don't know. We're going to have to watch it. But there is a price that if Bitcoin gets cheap enough, I would buy it. But Ethereum, I'm just dollar cost averaging in. Why? Again, the digital contracts are just going to be massive, and you're going to want to have some of this Ethereum that you can get interest income from, because that's where it's going. You can derive interest income from Ethereum that beats the hell out of what you get at the bank. And that's why you take some of your bank savings and dollar cost average into Ethereum, and probably, from what it looks like, Bitcoin at some point. And then there'll be a few other Ethereum-like coins out there that have to do with digital contracts and NFTs. And we'll buy a little bit of that too, just to hedge our bets. But again, some of these cryptocurrencies are a good substitute for bank savings that's sitting at the bank at 1% or less. All right, no questions today. I'm going to put out a whole bunch on the stocks of the week for tomorrow. Plug and play ETFs, and I really want you to focus on this correction's about a 1/3 to half over, probably. As I talked about in the Friday webinar, the large caps, you want to watch that Friday webinar. the large caps, the biggest stocks, those 6 stocks that are about half of the S&P 500, haven't come down yet, really. And when they do, that's it. Correction's over. And I think over the next month or two, that's going to happen. Now, it doesn't mean that if the Fed keeps tightening, we can't have a rally and then another drop. Certainly could. Could see a double bottom year. In which case, the second time, you either have to decide I'm going to try to trade it or I'm just going to close my eyes and wait for it to be over with. A lot of times, once you've bought near the bottom, you just hold on and let time fix things. That's what's happening with small caps right now. I got yelled at all of last year about the small caps I was buying. And the people who left, or the couple that fired me, in 2 or 3 years, they're going to look back and go, maybe I should have just held on and tried to understand what I was investing in. That's not the MO of humanity. The MO of humanity is to be emotional. If you can control your emotions and try to learn about the companies we're in, not reading articles of half-wits, of flunkies, go to the company's website and read their stuff. They'll tell you what they do. Those presentations are gold. The conference calls are gold if you truly want to try to understand the companies you're invested in. All right, have a fantastic day. If you drink, have a drink for Belle. She liked beer. She once picked up a bottle at a bonfire in her teeth that was still about half full, but was laying over in the grass. She picked it up from the bottle end and she tipped it up, got a mouthful of beer. She picked that bottle back up and got the rest after she was startled and dropped it. So she was a good dog. She really was. I'm going to miss her. And yeah, that's all I got to say about that. I'm going to miss her. All right, everybody, have a great rest of the day and focus on getting to know your stocks, understanding what these charts are telling us, and let the prices come to you.